Hey everyone, it's Monday, November 28th. We're super happy to be back live here with the Final Bar. We'll talk about this distribution that occurred through much of the day here today with the S&P, the Nasdaq finishing near the lows. What does this mean about the overall environment? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is designed to help us learn the lessons of market history by focusing on the evidence, focusing on what price is providing back to us. Stick with me with my voice. I was screaming loudly at the Seahawks game yesterday. Unfortunately, we did not get a win in overtime, but we had an absolute blast there with some StockCharts folks at the game. But bear with me if I go off for a second or two. Overall, an interesting day today. Quiet week last week, which is pretty normal during a shortened holiday week. Today, getting back to the distribution, I feel like we were experiencing previously. We'll talk about what this means in the short term and how that relates to the long term through the course of the show today. We'll hit the market from three directions: top down, bottom up, and sector relationships as well. Just to let you know about the upcoming schedule, we have some really cool guests lined up for you. Tomorrow on Tuesday, the 29th, for the first time, Stephen Bigelow. Stephen, if you don't know him, I've known him for a number of years. He's a candlestick expert and runs a site called the Candlestick Forum. We'll have him on the show and see what candles and what charts stand out for him. On Wednesday, the 30th, we have Javed Mirza from Canaccord Genuity in Toronto. On Thursday, the 1st, Mish Schneider from Market Gauge and host of Mish's Market Minute and other special events here on StockCharts TV. Let's continue on our show today with the market recap. As I mentioned in the introduction, bit of a distribution here. This is after last week's sort of quiet, net positive week, which is 100% normal. That's kind of what you'd expect in a holiday week. Kind of light, flat to positive, in general, leaning more bullish, but not a ton of volume, not a ton of, upward momentum. The Monday after the holiday, I always find very important because this is when kind of everyone's back. We now sort of reset and what happens from there. Now, besides the Thanksgiving holiday in the U.S., things still happening, obviously, around the world. And you have news out of China talking about COVID lockdowns, a lot of civil unrest starting to bubble up there related to that. You have Fed, governors talking about inflation and challenges there. All of that is netting out to the S&P 500 down 1.5% today, about the same for the Nasdaq Composite. Mid caps and small caps both down almost 2% today. The down move, by the way, pushed the S&P back below 4,000. That might be an important level to pay attention to, as we talked about, right? Above 4,000, below 4,000. While it's just a number, I think it means something. I think it means something pretty significant. That first digit has meaning because that's the number that a lot of traders, a lot of investors will be looking at. And whether or not we're above or below 4,000, I think tells you a lot about the sentiment. So today's distribution putting us back below there. The VIX started to move higher. So here we're back to that traditional relationship where the S&P, the Nasdaq move lower, the VIX moves higher. Now, again, they in general have an inverse relationship where the S&P goes up, the VIX will go down, and vice versa. But in practice, in the last couple of weeks, it's actually become quite disconnected. That is not, it's not like they're calculated off of each other, right? The VIX is based on the options market for the S&P index options. So there can be times when the market goes up or down, and it doesn't have that inverse relationship with the VIX. Today, kind of back to that normal relationship, the VIX is actually pushing higher. Now, what's interesting about that is the VIX was not quite to 20, but it was really close, right? It was 2060, 2050 on Friday's session. This was over the holiday break here. And what's interesting about that is if you look back in 2022, we'll bring up a chart of the VIX here in a few moments. Around 20 is where the S&P has actually topped out. So we'll bring up that chart and I'll show you exactly what I'm talking about here in a minute. Interest rates in general, not a ton of movement, but moving a little bit higher. This is after Friday rates came off quite a bit, opened a little bit lower and then pushed higher as bonds started to come off a bit. and 370 is where we end the day for the 10-year yield. The TLT, which is a long bond ETF, was actually up about 0.25%. And the dollar's back moving higher. And again, today sort of fell back into, in many ways, an average day in 2022 kind of looks like this, right? Stronger dollar, weaker risk assets, defense over offense. It kind of had a lot of those ingredients today for one day only. Commodities all in the red for us. The GLD, which is a gold ETF, was down about 0.8%. Silver down 2.33%. The broader commodity complex down about 0.6%. That's using the DBC, which is a pretty good ETF with a broad exposure. Very much an energy weighting to that, as with many of the ETFs focused on the commodity space, because energy is just such a big component of that. Oil prices down a bit, and the energy sector struggling quite a bit today. Crypto land, for the most part, all in the red. You have Bitcoin down about 1% over the weekend, got up in the mid 16,000s, back down and actually touched 16,000 earlier today. Currently just above there, around 16,235. Ether price is down just under 2% as well. Getting now below 1,200 and nearing that 1,000 level. Talk about an interesting rotation from a position of strength in 2021 to really getting all the way down to those severe low levels. Let's go quickly through as many of these as we can get to as we continue this big picture discussion of the markets. By the way, we didn't have a show on Friday, and thanks for allowing us, the StockCharts TV team, take a break and be with our families and loved ones for the Thanksgiving holiday. Hope you guys all had a good celebration of your own. But we normally on Friday update our market trend model. So I did do that. Not a big change, actually, but I'll show you where we're at. This is using weekly data. So I update it every Friday at the close. Long-term model remains bearish for me. The medium-term model turned bullish about a week and a half ago. That remains the case here as of last Friday. And the short-term model for me on Friday just find in decent shape. Now we've opened the new week, so you can see the new weekly bar here as the S&P coming down about 1.5% or so. You can see the short-term model getting nearer to that zero level. But again, I only update this every Friday, and that's an intentional process of being patient and waiting for the Friday close as a representation of the progress or lack of progress that was made in a particular week. So at this point, no real change from the last couple weeks. Now, here's what the chart of the S&P looks like. I have to actually update my annotations a bit. I'm going to take this blue shaded area and pop it over just a touch. This is showing what I would consider a significant area of resistance. So it is not lost on me that we rallied up to that area about 2 weeks ago, pulled back to 3,900, made a second foray into this shaded area last week, Wednesday into Friday, and now coming back. So these are lighter volume days for my holiday week. We all get back to our desks and start trading again, and the market's coming off. So back below that 4,000 level. Besides being a big round number, it's also a key Fibonacci level. We talked about that a lot in recent weeks, so I don't need to continue it any further. So in August, we rallied to the 200-day. We rallied to a key Fibonacci level. We rolled over. You see the similar sort of pattern here so far in late November. The real question, I think, going into the next couple of weeks as we finish off a challenging and eventful 2022 is, do we get that seasonal tendency, which is November and December tends to be pretty strong. So far, November, pretty decent, right? Particularly after the midterm elections, or do we fall victim to a bear market phase that we've been in for much of 2022? I think that's an open question. I'm leaning more negative than positive because of the lack of follow through above the 200-day moving average and other things that we've talked about, of course, through the course of the show here. Just one more, maybe two, if I could, before we go on to our next segment, sector setups. The next thing I wanted to show you was Ether. And the reason why I want to show Ethereum, again, Bitcoin is the one that's more commonly talked about. Ethereum arguably has more practical applications, but I think that's, again, something that'll be filled in the weeks and months and years and decades to come. We'll figure out what all these things mean for the long term. But I think it's worth noting as Ethereum prices roll down a little bit back below 1,200, 1,000 is an important level. That's where we actually bottomed out on a closing basis in June. We then tested that level in late June and in mid-July, and all of those times we rallied off of there. We're now getting back to that level, so I would anticipate some decent support around the 1,000 level. I think that's where a lot of investors that either had been buying Bitcoin and are holding off or have been scared away from it gets down to 1,000. You really have to think about how low this is relative to the long-term potential in something like Ethereum. Full disclosure, I own Bitcoin and Ethereum in long-term accounts. They're not trading accounts or anything. These are more long-term plays, but I'm interested to see if you do get buyers coming in. If you get below 1100, get back within the range of those June and July lows. I think it could be an interesting chart to look at. Just finally, the VIX. I talked about sentiment. I just want to mention we're talking about big picture, and we're talking about where we're at right now within the cycle. We rallied July and August. The VIX came down to 20. We rolled over. That happens very similar sort of pattern in late March. So the two most recent rallies, and even February before then, you rallied higher. The VIX came down to 20, and the VIX volatility increased, and the market sold off. We didn't get quite to the actual 20, but we got really, really close. And I'm wondering if that was close enough, and maybe this sell-off today is the beginning of that next leg down. Again, the charts will tell you what happens, but I would say 4,000 is a really important level. If you see volatility increase from here, that could tell you a lot about the uncertainty in this market. And uncertainty usually means negativity. We don't usually go up on great, thriving uncertainty, right? It's usually more of a downtrend type of thing. Let's go on to our next segment here, sector setups. Thanks for letting me spend a little more time on the big picture. I thought some of those charts were important to touch on, but as we rotate now to the sector setups, we'll use Julius de Kempener's relative rotation graph. I was chatting with Julius earlier today as in one of our management discussions. We were talking about a number of different things, some different data sets that we're looking to bring in. At the end of the day, when I'm working with Julius, we often start, of course, with the RRG. This is a visualization he designed, beautifully illustrates the rotation of different assets around a benchmark. Here we're looking at the 11 S&P sectors using weekly data. This is the longer term view that I like to start with because it really gives you, essentially the lay of the land, right? How different sectors are rotating versus the S&P 500, which is basically at the crosshairs in the middle. You can see that the energy sector has been certainly the outlier, and by any definition here. And certainly recently we've seen the energy sector cool off a bit, but the relative strength continuing to improve. So overall, it's been energy and then everything else. Now, what about the everything else? What's continuing to improve using this weekly data? Well, here are the ones that are all within the leading quadrant. I'm going to zoom in a little bit because some of these are a little hard to pick apart here. Yeah, the industrial sector, the XLI, which is sort of heading northeast, and I've zoomed into just this area of the chart so we can see things a little bit better. A nice move to the upside. This is actually, oh boy, sorry. This is actually the financial sector that's hidden behind industrial. So both of those in the leading quadrant heading east, which is good. Industrial is doing better in terms of improving momentum while the relative strength is improving as well. You also have materials in the sort of left part of the leading quadrant, just going into the leading quadrant last week and now continuing to push northeast. That's probably one of the more promising sectors. If I had to pick the two, besides energy, it's industrials, it's materials, and we're back to sort of this late cyclical leadership, what I would call the MEI trade, right? This is where you have materials, energy, and industrials all in a position of strength. And again, this is based purely on relative strength, on the relative performance of these sectors versus everything else. It's not looking at anything beyond that. It's just ways of statistically analyzing relative strength. So in general, go with what's working and don't go with what's not working is the general way I would describe my experience using the RG. So what's not working? Utilities, consumer discretionary, and communication services, all three of those in the lagging quadrant and heading southwest. I'd want to see some improvement, kind of what we're seeing with technology, before you start to get interested in one of those sectors. Again, using the RRG as your framework there of that analysis. Now I'd like to look at the 11 S&P sectors using the candle glance function. I think this was on maybe Friday before last. We did a segment called Power Up where we talked particularly about the candle glance functionality. So go back to that 2 Fridays ago if you missed. I think that's Friday the 18th or something around that date. But here we're looking at the 11 S&P sectors and then the S&P 500 at the bottom. When you zoom out of these charts, and really you do it by making them smaller and packing a bunch on here, you immediately start to see relationships, or at least that's what I do. You start to see what's working, you see what's not. You see what looks similar to other charts, what looks very different. So a general way that I would think about this is, number one, which stocks or which ETFs, are above their moving averages, right? Which ones are in a position of strength, meaning they're in an uptrend, and the definition of an uptrend would be above their moving average, and particularly above their 200-day moving average. So which fit that criteria? Consumer staples, financials, healthcare, energy, industrials, materials, utilities actually maybe right back on the 200-day, but really, really close. And that's about it. It's about half the sectors above their 200-day moving average. That makes sense when you think about the percent of S&P stocks above their 200-day moving average. kind of right about 50%, sort of in a similar sort of level. So not surprising to see about half the sectors above their 200-day. That means the rest of these are below their 200-day. So in general, I would much rather own things and much rather be following things that are in an uptrend than a downtrend. So everything else is in a confirmed downtrend. Again, using the simple analysis of it, is it below its 200-day? That's communication services, consumer discretionary, technology, and real estate, right? And the rest of these are all above there. So what's concerning to me when I think about the S&P testing its own 200-day moving average and so far failing to get above there, the challenge I have is that those major sectors that I just mentioned are the FANG sectors. Those are the growthy sectors that are very heavily weighted in our benchmark. So if those are unable to push above their 200-day, what are the chances that the S&P 500 itself is going to do it? We could be facing that scenario, and we've talked about this many times during the course of the year. Obviously, energy having a pretty decent year while the S&P and the Nasdaq have been struggling. We could be in that environment where seasonal strength is manifested in particular sectors. Maybe the MEI sectors do particularly well. Our major benchmarks are kind of struggling because the growthy stuff is what's struggling to push to the upside. That is one of the scenarios I'll certainly be thinking about as we go through year end and start to think forward to the year to come. Let's take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is such a pleasure to do this show for you. We have a lot of really cool things planned for the Final Bar going into the beginning of next year. Excited to share that with you when we're ready to go, but it will feature us in our new studio, which we're putting the finishing touches on here soon. Just a couple quick announcements before we continue on with our Shifting Stocks segment. First off, we welcome your questions. We're going to do a mailbag segment on Tuesday and Friday this week, and we'd love to feature one of your questions live on the air. Our email is the best way to get your questions in front of us. thefinalbar@stockcharts.com is our email address. We're also on Twitter @FinalBarSCTV, and we're on YouTube. Subscribe to our YouTube channel if you could, and put a comment below the video you're watching. We'll gather those questions, hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That's our on-demand platform. Larry Williams did his most recent market outlook last week. We also had a really cool special discussion on point and figure charting from Bruce Frazier and Joe Rabel, two of our longtime hosts on StockCharts TV that I thought was really well done. All of that and so many great special events, guest interviews, and so much more are available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on our show today with our third segment, Shifting Stocks. This completes our three-pronged approach to market analysis, really just a small version of what I like to do every week. For my premium members of Market Misbehavior and in my own analytical process I've been refining over a couple of years or so. We're going to start Shifting Stocks, looking at some individual names, of course, and we'll start with Apple. And again, I think there is one set of analyses, one set of conclusions you can make by looking at the major averages, by looking at breadth and sentiment. Those are all big picture. But one of my great takeaways from a fantastic experience at Fidelity, working with money managers there and a team of technical analysts, was really thinking about the lessons you can learn by looking at individual stocks. And I found with individual investors, we spend a lot more time talking about big picture stuff, and probably not enough thinking about relative strength, which is the performance of a stock or ETF versus other stocks. That's why I try to mention it 800 times every episode, just keep reinforcing the importance of relative strength in your analysis, but also looking at individual stocks. And a lot of my time at Fidelity, we wouldn't even look at the major benchmarks very closely. We would focus almost all of our attention on individual names, because by looking at individual stocks, you kind of already know what the chart of the S&P is going to look like, because you've seen the patterns on the key stocks that drive the performance of those indexes. So let's start with one of the biggest, Apple. Apple, obviously one of the largest stocks in the S&P, certainly in the Nasdaq 100, and very much in the XOK. It's probably about a quarter of that ETF would be my guess. I don't have it in front of me, but I think that's about right. You can see when you look at the chart of Apple, when I talk about skepticism about further upside for stocks, charts like Apple are part of it. And just recently in the last week, we've had just yet another reminder that all is not well, I would argue, when you look at some individual names. And here's what I'm talking about. Look at this last couple of weeks, and I might jump into a shorter chart, kind of like this one. Yeah, not too bad, right? So this is just looking at the last month or so, 2 months, excuse me, going back to late September. Most recently, we sort of made this double bottom short term, right? We had the low in mid-October. We retested those low in November, and Apple starts to rally. Now, all eyes on the 200-day moving average and the highs from late October, right? The question on a chart like this, I think anytime when you have a clear level of support and clear level of resistance, which one breaks, right? Do we break to new swing highs or break to new swing lows? John Bollinger years ago taught me the idea that before a big break, you have a period of lesser volatility. You often do, right? So when you see a narrowing of the range, you look to see which way the stock breaks. Now, on a shorter time frame, you even had that same type of thing. So bear with me as I start drawing a bunch of lines, but I just want to show you kind of what I have here. You have this big thrust out of the lows here to get to the intraday high there. From there, we stalled out, and then you have what's called, I would argue, a pennant pattern, which is a pattern of lower highs and higher lows consolidating around an equilibrium point. So basically what happened here is Apple rallied from 130s to about 150, and from there sort of stalled out, right? And we sort of rotated around 149, 150 is about the middle point of that pattern. We have a narrowing of the range. We have an equilibrium. So essentially the market is telling over the last couple of weeks, Apple is worth about 149.50 or so, right? Sort of the midpoint here. And the question is, at what point do we break out of that pattern? Do we break above and resolve that pattern to the upside, indicating buyers getting a little more excited and a little more optimistic and buying power entering in as additional demand comes in? Or do we get more pessimistic? Do sellers take control? Lack of buying power, selling pressure engages as people are skeptical about upside, and the pattern resolves to the downside. And that second option is what actually has played out on the chart of Apple, right? So not only did we not break above the 200-day moving average, we also did not get above the October high. And now we've broken out of this pattern to the downside. And this is technically considered a continuation pattern. When you have a rally into this pattern, more often than not, you'd expect that to complete to the upside, right? Because it's sort of a pause before we continue. But this is giving you the opposite look. So in the short term, I'm seeing more weakness than strength on the chart of Apple. And that's why I wanted to start with that, just thinking about some of these short-term signals. Now, sticking within the pattern of the the list of stocks, the what I call the phenomena stocks, or the updated list of the FANG stocks. I have 8 names that are sort of in that bucket: Netflix, Amazon, Apple, Microsoft, Meta, Adobe, and so forth. What I'm seeing here is not a lot of things to get excited about. And one of the more optimistic charts, or one of the more constructive charts, I think, for quite some time has been Netflix, right? Netflix had this double bottom pattern May and June. It broke out of that, broke above $200, which was key, then stalled out around 250. From there, 250 became resistance. We gapped above there in mid-October and then came back to that level and rotated higher. Just about a week and a half ago, we made a new swing high, getting above 300, getting above the October highs. This is super encouraging. That's been it, though. That move, that day has been it. Since then, it's been more about distribution. We can see also as we powered to new highs, it was on weaker momentum. So I'm concerned about what I'd call a bearish momentum divergence and seeing signs of upside exhaustion. Now, what's interesting about this chart is I think it gives you a really clear level of support. So that breakout level is 250. That was the high from August. That also is the low from November. That's also right about where the 200-day moving average is going to end up over the next couple of weeks. So the chart of Netflix might be another really important one to watch. Do we hold that 250 level if we do continue to move down from here? That would keep us above the November low, keep us above the 200-day. If and when that would break, I think that's lights out, strong probability of the major benchmarks struggling through year end, which again would be very unusual, but I've learned to not be surprised by unusual. That tends to happen more than you would probably expect when you're looking at stocks. Now, it's not all bad, right? There are charts that are actually working. It's one of the things that I've reminded my premium members all year, right? Even though overall we've been fairly defensive and been fairly cautious about the overall averages and the major benchmarks, for all the reasons we've shared on the show as well. There have always been individual names that are working just fine, and that's been the case through the entire year. The first half, it was energy and other energy-like things, and then since then, there's always been individual names that have popped up here. Wynn Resorts is one that I would highlight here. Again, while I'm concerned about the overall strength of the equity space, I'm not surprised to see some stocks are working in a chart like this. Again, really classic entry point if you use the best practices of technical analysis. Sort of 70 was the resistance here. In October, we broke above the 200-day, pulled back. Now finally getting above 70. We pulled back actually to the October breakout level and rotating higher, which means as long as we hold that most recent low, not a bad chart, something I would probably be keeping an eye on. We only have time for like 1 or 2 more charts. This is rough. But let's get to semiconductors. We'll stop it here. SMH is the semiconductor ETF. I want to highlight that this is stalled out at the 200-day moving average. So it's not just that the S&P is struggling to get above its 200-day. I'm seeing that type of pattern, that type of uncertainty bubbling up in a lot of different individual charts. And it's not just semiconductors, right? If you look at MU, this failed to get above its August high, also failed to reach the 200-day, now really pulling back within the range that we saw in October on semiconductors. ON is another one, given the opportunity to break to a new 52-week high, has failed to do so and now pulling back a little bit. If the market is constructed between now and year end, charts like ON and Micron and Netflix and others most likely follow through to the upside, recognizing an influx of buyers. We're not seeing it just yet. We need to wrap this show, folks. This is always so much fun. I wish we could spend more time. We got to wrap it. Here's the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I will never try to sugarcoat things, and I will try to provide as much of the evidence as I can in the short time we have together every afternoon, but it is a pleasure to do so. This is one of the charts that we highlighted last week, and I think the week before, which is the bullish percent index on the S&P 500. And you can see the 3 previous times we got above 70% and came back down. Those have been basically the most significant tops in 2022. And I mentioned we just barely got below 70%, but something interesting has happened. Last week, when again, I'm on vacation and eating turkey, you can see that we didn't get a follow-through below 70. It actually bounced off of the 70% level and pushed up a little bit. Now, I'm interested to see how this plays out through the course of this week. A lot of stocks down today, not enough to register sell signals on their point and figure charts necessarily. Usually takes a little bit more than that. But this, I think, remains a chart to watch to see if we get below that 70% level. I thought we had done it here when I shared this about a week ago. It turns out we didn't follow through at all. We sort of continued above there. So we'll keep monitoring that chart to see what happens. Chart number 2, I mentioned the VIX earlier when we were talking about the big picture, our market recap. I just want to highlight, this is one of the charts I'll be watching. When you think about the seasonal tendencies of stocks to do well, November and December, particularly in a midterm election year, a chart like this should help us navigate this. This is on an inverted scale at the top, high yield spread. So high yield spreads narrowing means these values decrease, which means high yield bond investors require less premium to buy the debt of risky companies. If all of that happens, the market's pretty in pretty good shape. And you can see since late September, spreads have been coming in. This line has been going higher. Same, the volatility picture has gotten more bullish, right? As the VIX has come down. Again, I'm flipping it over here to show that when the VIX goes down, it's bullish for stocks. You can see since early October, tightening high yield spreads, tightening volatility, stronger stocks. Watch this chart to see if spreads widen, which I think they did today. We'll update that data here very soon. See if the VIX continues to go higher, which it certainly did today. And that would most likely line up with stocks struggling. So this is a really important chart to watch. Finally, Ulta Beauty. Let's finish on a strong note. This is one of the stocks making a new 52-week high today. They are out there, so make sure you are scanning for ideas. In general, if you want to outperform the S&P 500, you want to own things that are outperforming the S&P 500. Ulta certainly fits that bill. Folks, that is a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. As a reminder, today is Cyber Monday. Don't miss an opportunity to lock in a fantastic rate for your StockCharts Premium membership. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.